Every second of every trading day, billions of dollars change hands in the stock market. But hidden beneath the surface of price charts and ticker symbols lies a sophisticated machine, one designed to harvest the hopes, dreams, and trading accounts of ordinary Americans. This is the story of how Wall Street turned your trading app into their greatest weapon, and how the very platforms that promise to democratize investing may actually be working against you. In 2013, two Stanford roommates launched an app with a revolutionary promise: free stock trading for everyone. No commissions, no minimums, just you and the market. We're on a mission to democratize finance for all. Within years, the app had 20 million users. Other brokerages eliminated commissions to compete. The revolution, it seemed, had won. But there was something these traders didn't know. Something the industry didn't want them to understand. The trades weren't really free. The users weren't the customers. They were the product. When you tap buy on your trading app, your order doesn't go directly to the stock exchange. Instead, it's sold to the highest bidder. This practice is called payment for order flow, or PFOF. In 2020, retail brokerages collected approximately $2.5 billion in these payments. By 2023, that number had grown to an estimated $3 billion. Some major trading apps receive over half their revenue this way.
Think about it this way. If you are not paying for the product, then you are the product. These firms aren't paying billions of dollars out of charity. They're paying because your orders are extremely valuable.
But valuable to whom? And for what purpose? When a market maker pays for your order, they receive something valuable: information. They see your order the moment it arrives. They see the aggregate patterns across millions of orders, the stop-loss clusters, the limit order levels, the behavioral tendencies that repeat across retail traders as a group.
With modern technology, we can analyze incoming orders and predict what's going to happen in milliseconds. By the time your order executes, we've already positioned ourselves to profit. We know retail traders place stop losses at round numbers. We know they buy after news releases. We know they panic sell on drops. The algorithm knows everything.
This creates a structural information advantage. The market maker sees your order the moment it arrives, evaluates market conditions, and positions itself to profit from the spread before executing your trade. The industry calls this price improvement. Critics call it something else entirely. In 2008, an entrepreneur had an idea. What if traders could share their thoughts about stocks in real time, like Twitter for the market? Social trading platforms were born. They introduced the hashtag, the $sign, before a stock symbol that's now ubiquitous on social media. By 2024, the largest platform had over 10 million users posting their bullish and bearish predictions in real time. Users believed they were building a community, helping each other identify opportunities, sharing research, warning of risks. But these platforms weren't just building a community. They were building something far more valuable to a very different audience: a real-time database of exactly what retail traders think, feel, and plan to do with their money. Here's what users didn't know. These social trading platforms were actively monetizing their sentiments. Through partnerships with data analytics firms, every bullish and bearish post, every mention of a stock symbol, every expression of hope or fear was being collected, analyzed, scored, and packaged for sale. Let that sink in. The community platforms where retail traders share ideas to help each other sell that information to the very institutions trading against them.
Retail sentiment is one of the most reliable contrarian signals we have. When everyone on social media is convinced a stock is going to the moon, when sentiment platforms show 90% bullish, that's usually about when we start shorting it. The crowd is almost always wrong at extremes.
Even the legendary meme stock squeeze of 2021 followed this pattern. As the stock climbed toward $483, Retail sentiment on social platforms hit record bullish levels, over 95% bulls. Professional traders who had access to this sentiment data knew what was coming. Just days later, the stock collapsed to 40.
I was so sure. Everyone was sure. The sentiment was off the charts positive. Every post, every thread, bulls everywhere. I put my entire savings in at 300, convinced it was going to 1,000. I lost everything. Later, I found out hedge funds were watching that same sentiment data and using it to time their exit. We were the exit liquidity.
This wasn't random bad luck. This was the system working exactly as designed. The more confident retail traders became, the more data they generated. The more data they generated, the clearer the contrarian signal became. The clearer the signal, the more institutions profited from taking the opposite position. But sentiment data is just one input in an increasingly sophisticated algorithmic system. Today's trading algorithms don't just react to what retail traders do. They identify patterns in aggregate retail behavior and position accordingly.
Modern machine learning models ingest everything: social media posts, news sentiment, order flow patterns, even the timing of when retail traders typically place orders. These systems identify when retail traders log in, when they check prices, when they're most likely to panic. The algorithms know retail behavior better than retail traders know themselves.
Market researchers have identified another crucial pattern. Institutional and retail traders operate on completely different schedules, and this timing reveals everything.
The Smart Money Index is based on a simple observation. Retail traders dominate the first 30 minutes of trading, acting on overnight news and morning emotions. But institutional traders, the so-called smart money, tend to position themselves in the final hour, after they've analyzed the day's flow and retail behavior.
Why? Because retail traders trade on emotion and news in the morning. Institutional traders trade on analysis and positioning in the afternoon. By watching which direction the smart money moves in the final hour, savvy traders can identify when retail enthusiasm is about to be exploited. Perhaps the most damning statistic in retail trading is also the most consistent. Studies show that between 70 and 95% of active retail traders lose money. This isn't occasional bad luck. This is systematic extraction.
It's classic survivorship bias combined with overconfidence. We see the success stories: someone who made $1 million on a meme stock, a teenager who turned 1,000 into 100,000. But we don't see the thousands who lost their savings trying to replicate it. For every winner's story, there are hundreds of silent losers.
When you add it all up, the numbers are staggering. In 2023 alone, retail brokerages collected approximately $3 billion in payment for order flow. Studies estimate that active retail traders collectively lose tens of billions each year. That's not counting the additional losses from emotional trading and poor execution that don't show up in PFOF statistics. Tens of billions of dollars every year, flowing from the pockets of ordinary Americans, teachers, nurses, small business owners, to institutional investors, hedge funds, and high-frequency trading firms. This is not wealth creation. This is wealth transfer. The stock market, for many retail participants, functions as a reverse lottery, where the house always wins and the game is designed to keep you playing until you lose. And retail traders win? Yes, but only by understanding the game they're actually playing. Not the game the platforms advertise. The game that's actually happening beneath the surface.
The most successful retail traders I've studied share one critical trait: they've stopped trying to beat Wall Street at its own game. Instead, they've learned to identify when other retail traders are making emotional decisions, and they position themselves on the opposite side. They've become the house instead of the gambler.
Knowledge is the only sustainable edge. Understanding that your sentiment is being monitored, your orders are being sold, your behavior is being predicted. That understanding is the first step toward breaking free from the retail trap. The stock market is not a casino. It's a battlefield. On one side, algorithms, data centers, sentiment surveillance, and the combined resources of the financial establishment. On the other, ordinary people trying to build wealth in a system designed to extract it. The question was never whether you can win. Some do. The question was whether you understand the game you're playing, whether you know how the machine works, whether you're willing to trade differently than the 70 to 95% who lose. Because once you see the retail trap, once you truly understand how your data, sentiment, and behavior are weaponized against you, you can never trade the same way again. And that knowledge, that might be the only real edge retail traders have ever had. The game continues, but now you know the rules.